I'm speaking with David Hallifax, Head of Private Wealth Australia New Zealand at Coller Capital. David, as always, a pleasure having you at the Inside Networks Alternative Symposium.
Thanks very much, Jimmy. Glad to be here.
Coller, of course, is a specialist in secondaries, a powerhouse in the secondaries market. But for advisors who are newer to this space, Dave, describe in simple terms what private equity and private credit secondaries are and why that market's growing.
Yeah, so private equity and private credit secondaries are basically when a manager like Coller Capital acquires an interest either in private equities or private credit from an existing investor in a primary fund. We provide capital, so gives them liquidity, and in turn we get access to a diversified portfolio of underlying securities.
Transaction volumes in secondaries have expanded rapidly. How's 2026 shaping up, Dave, in terms of both LP-led deals and GP-led deals, and please define those terms for us.
Yeah, absolutely. So let's just maybe talk about the definition. So an LP-led transaction is referred to as a limited partner. That's actually the superannuation fund or institutional investor. The GP is the general partner. That's actually the private equity firm. As far as transaction volumes go, in 2025 we saw volumes at 200 billion USD. That was up from the prior year of about 160 billion. So that's around about a 15 to 20% growth rate we've seen over the last 5 years in secondaries. And we're expecting the market to be more like $500 billion by 2030. So it's very, very significant. And that's split across both LP-led transactions and GP-led transactions. I mean, the year ahead, we would expect at least 300 billion plus in volume being transacted in the year ahead. And that's probably going to be tilted a little bit more towards the GP-led transactions because there's definitely been a lot of momentum and growth in that area.
So why are limited partners selling today, and how would you characterise current pricing relative to previous cycles?
Yeah, so there's two types of sellers in the secondary market from an LP perspective. The first one is I would define as a motivated seller, and the second one would be a distressed seller. And there's a whole range of different reasons why LPs would sell in the market. A motivated seller could be consolidation in the superannuation industry that we've seen here in Australia as an example. And then an example on the distress side would be the denominator effect, where listed markets drop and the asset allocation in private markets is increased and there's a need to sell those assets. And there's various reasons for that.
Dave, you mentioned before some of the volumes you're seeing in the secondaries markets, and while they're growing at very healthy rates, still, given the huge pools of money out there in the primary markets, it seems like secondaries have a lot of penetration still to go.
Absolutely, yeah. If you think about the primary market, it's sitting at $15 trillion US. I mean, 2.2 trillion was actually allocated into private equity assets last year. So yeah, the secondaries market still has a long way to go to catch up. And we've seen really the secondaries market has started in private equity secondaries, but we're actually also seeing that feed into private credit secondaries and even infrastructure secondaries and other real assets. So a long way to catch up.
Secondaries are often described as offering improved risk-adjusted returns. How do you explain the return profile of secondaries, particularly around areas such as the J-curve and the dampening of volatility?
Yeah, so secondaries plays an important role for institutional and private wealth clients because it offers instant diversification to a pool of assets, either in private equity or private credit. We mitigate the J-curve, so you get instant deployment into those assets. There's no blind pool risk, so we get to see the assets that we're actually buying, and we're also able to select the type of assets that we like and those that we don't like. So really avoiding the losers and backing the winners is really important. But from a risk-adjusted return perspective, over the last 20 years, the median return in private equity secondaries has outperformed the median return in private equity buyout funds. And on a risk-adjusted basis, private equity secondaries and even private credit secondaries is a very low probability of loss relative to the primary market. So in private equity, as an example, you're 10 times less likely to lose money in secondaries than what you are in primary funds.
Seeing those growth rates in secondaries, obviously there already are competitors for you, and then there will obviously be more. So what differentiates Coller Capital in terms of its underwriting discipline and its valuation skills and its execution? What really makes you feel confident you can stay at the top of this market?
Yeah, well, if you go back to 1990 when Jeremy Coller, the founder of our firm, established the business, it's fair to say that there was very limited competition because Jeremy really was the first to launch an institutional offering in that space. But we've been in the game for 35 years, and so for a good 30 years we've seen a lot of competition. So we're not fazed by competition. What really differentiates Coller Capital is the fact that we have a scalable business across both private equity and private credit. We've been in the game for a long time, so there's a lot of scars attached to that. We've been through various market cycles. We have the largest team purely dedicated to secondaries in both private equity and in private credit, and that gives us a competitive edge in regards to looking at multiple assets at any one time. So there's lots of competitive advantage that Coller has, and they're just a couple of them.
Dave, in a very short period of time, I'll give you 45 seconds. Take us through what secondaries are and what role they perform.
Okay, well, secondaries is really buying an existing asset off an existing investor. The key benefits of secondaries is that we get access to a diversified portfolio of private equity or private credit assets. We actually buy those at a discount, so there is a cost to liquidity for an institutional client to sell down those assets. In doing that, we also get or mitigate the J-curve. We have no blind pool risk in the strategy, and from a risk-adjusted perspective, the returns in secondaries is very compelling for investors.
Dave Hallifax, Coller Capital, always a pleasure. Thank you for your time today.
Thanks very much.